Hey traders, welcome back. So in this video I'm going to talk about what is the safest way to trade. Is there a safe way to trade? There isn't really, so that's a caveat. Let's get that right out of the way now. There is no safe way to trade. There is risk in trading whatever we do. However, there are little things and tricks and things and strategies and markets we can get involved in that reduce the risk down to maybe a level that's palatable for you. So first thing we're going to look at is the market that you are trading. Now, if you're trading biotechs, if you're trading small caps, if you're trading instruments like that, obviously they're not that accessible to spread bettors. However, if you are getting involved in them, be very, very careful, because these are things that could just go ballistic and then they could just completely crash. But then moving on from that, stuff that you may get involved in are standard tech stocks like Snapchat, Twitter, Netflix. Apple not so much, has calmed down a little bit more, but those kind of new ones that are coming into it, they're just literally based on a story. They're maybe not making much revenue, and so they can be very sensitive to any comments that come out, any kind of inferred news that may affect them. Those are the sort of things that are swinging around 5-10% in a day. Obviously, if you're getting involved in those, that is less safe. That is more risk, should I say, and less safe. If you're moving on to stuff that's in the Dow, like Disney or Caterpillar or any of these kind of slow chugging stocks that have been around a while, perhaps there's not much in the news about them at the moment. Perhaps everything seems fine with their earnings. They're plodding along. So from day to day, from sort of Monday to Friday, if there's no external catalyst, they're just going to chug along, 1% a day, either way, 2%, that kind of thing. Now, obviously, you can dial down the risk by reducing your size, and we'll talk about that in a second. But if you're thinking about just generally trading something, instrument, the less volatile the instrument, the less risk, generally speaking. Okay, number two, let's talk about your strategy. If you're trading, day trading momentum strategies, then this is a high risk way to trade, because you're looking for explosion. You're going to be trading very frequently, so you're paying more spread, so it's costing you more money. There's a lot more emotion involved in it. And this is the sort of thing, if you're looking for pure direction in something, that is a high risk strategy. If, however, you were doing like a mean reversion strategy based on pair trading, so let's say you were pair trading the DAX against the CAC, for example, buying DAX, selling CAC. Even though there is still inherent risk in that, of course, you are reducing the risk that you have in the day, because if the whole market is going up, the DAX and the CAC are going up. If the whole market goes down, the DAX and the CAC are going down. You're trying to get the difference between the two. Obviously, they're going to go out of sync at some point, and you're either going to profit or loss from it, but you're going to be somewhat cushioned from big swings based on external news events or something like that. So it kind of caps your risk. And the same if you're pair trading, let's say that was example, or we were talking DAX, weren't we? But FTSE, DAX, CAC, that kind of stuff. If you're pair trading stocks like Coca-Cola, Pepsi, or UPS, FedEx, or Tesco, Sainsbury's, any of those kind of things that we've talked about before in previous videos, go and check it out, pair trading strategy. That's going to limit your risk a little bit to extreme moves and extreme shocks one way or the other. So picking the market, picking the strategy. What else have we got that we can limit our risk? Well, number three is overnight risk. What do I mean by that? Well, if you're trading swing trading and you hold a position overnight, immediately you have relinquished your control of risk. When that market closes, if you're trading a stock, as soon as the bell goes and it closes, you can't trade it anymore. You are giving up control of the risk. That stock could gap up or down overnight based on any news that comes out, or any adverse, the global thing that affects it, global influence that affects it, sector influence that affects it, stock specific, anything that can influence that stock could be gapping up or down overnight. Now, obviously, you're going to exaggerate this if you start trading, your tech stocks and things like that. So you've got overnight risk and you're trading that, then you really are opening yourself up for adverse moves or moves in your favor. So how do you eliminate that? Well, obviously, if you're holding overnight, you can't eliminate that. If you're holding stocks overnight, it's impossible to eliminate that overnight risk. So to eliminate it, you just close your trades each day. You become a day trader and you eliminate this aspect of risk. But obviously, day trader has other aspects of risk in it. But to eliminate the overnight risk, close out your positions each day. If you're trading currencies, you can trade those Monday to Friday. They trade at 24 hours, 24/5. Friday night, you need to close it so you don't get the weekend risk. That will eliminate any gap risk over the weekend. And same with some of the indices. Some of them will trade 24 hours a day, 5 days a week. You need to look at, depending on the broker that you're using, as to when you can open and close those trades. So just understanding that when something closes and you can't trade it, the risk then becomes uncontrollable. If it's trading and ticking around back and forth, then you can cap the amount of risk. Obviously, there is still the ultimate risk that you could get a massive move in one direction, that you get slippage on, if with your stop loss, but we're just talking here about the overnight risk.